Good day, everyone. Rose here. Alright, so I wrote a thread recently on the basics of liquidity, and I promised to do a follow-up video delving more deeply into the idea and concepts of liquidity and how we can get better at picking out these areas of liquidity and also using them in our trading. Okay, so just a brief recap, you can actually find everything here on the basics of liquidity, right? What liquidity is and all of that. I think I'll just do a quick recap here. Like, liquidity basically means money. Liquidity basically means money, and this money we speak about in the financial markets exists in the form of orders. Exists in the form of orders. So what this basically means is your 1 lots, your 2 lots, your 3 lots, all of those orders you place into the market. So when you're trading, okay, they translate to money, and those money translates to liquidity. Now, one basic knowledge you would have as a trader, or even just looking at the price chart, is say, for example, let's say, for example, you're trying to go short from this high, or you're trying to go short somewhere around this price action. You're selling. Where would you reasonably put your stop loss? It's going to likely be somewhere up here, right? Because that's where you feel is going to be the safest. So maybe somewhere around this high, or maybe even somewhere around up here. If you're a lot more conservative, right, you don't want to avoid any issue of a loss, right? You'd say, oh, maybe somewhere around here. And this is a basic theme among traders, right? We feel the safest places to put our stop loss orders when we take a trade are above the highs, or where? Below the lows. Now, what this does is, since everybody or the bulk of people are thinking alike as to where their stop loss is supposed to be placed, so you have a huge amount of orders resting at these levels, these highs and lows, at the swing points. So this kind of like leads to the notion, right? We usually hear in the first markets where you hear that the liquidity is resting at the highs and the lows. The bulk of the liquidity is resting at the highs and the lows, and not just even stop loss orders. You also have people who are trying to get into trades on the breakout. So they would have their their buy stop orders here for them to enter once price breaks out of this level to continue, right? Because we obviously have breakout traders also in the financial market. So this different combination of people, right, placing these orders for different reasons leads to volume building up at these swing points, liquidity building at the swing points. So that's the explanation to why we say liquidity is resting at these highs and these lows. And yeah, you can go to read up on all of this here, right? They explained. But then I also left a very, very huge caveat, right? During the explanation of this, which is the fact that I said, given that we have two types of liquidity, the internal range liquidity and the external range liquidity, each of them are relevant to a specific phase of price delivery. Again, I'm going to just quickly explain what I mean by that. So like we said, internal range liquidity simply means liquidity resting inside of the range. So if you have a range from here to here, so this is the low and this is the high. What internal range liquidity basically means is there's a sort of low, right? There's a sort of minor low resting inside of that range, right? Inside of this range, there's a minor low resting inside of there that is going to serve as LQ. Now, since it is internal to the range low and the range high, that is why it's called internal range liquidity. In the same vein, external range liquidity basically refers to liquidity resting outside of the range. So it could be an old high resting outside of this range. It could also be this high itself, right? Your range high itself is also an external range liquidity. Okay, so if you have a scenario where price pulls back and goes to this, that's external range liquidity. Now, that being said, let's go back to what I said, right? Which was that The different phases of price delivery correlates with, the different types of liquidity, internal or external. And this is what I basically mean. When it comes to the phases of price delivery, we understand that we have 4 phases. Okay, we understand we have 4 phases of PD. The first one being consolidation phase. After the consolidation phase, we also have expansion. We also have retracements. And then we have reversal. So these are the 4 phases of price delivery: consolidation, expansion, retracement, reversal. Price is usually moving between those 4 phases. Either it's in a consolidation, or it's expanding, or it's retracing, or we're in a state of complete reversal where the trend changes from either bullish to bearish or from bearish to bullish. And I explained that these different phases of price delivery correlates with this liquidity. And this is what I mean. The expectation when price takes our internal range liquidity is for it to continue its expansion. So say for example, we have a price action that looks something like this. Now in this simple diagram, we understand that, oh, this is our current range in price, right? This low to this high, that's our current range in price. And we understand that this is likely going to be internal range liquidity. Now, what's the expectation? The expectation is that once price takes out this internal range liquidity, it does what? It expands. So that's why I said internal range liquidity is related to expectation of expansion in price, whereas your external range liquidity, right? Right. So let's assume this is external range. This is the range high that price is taking out here. Remember what I said? Internal, expansion, continuation. Now for external, the expectation is what? After price takes out the swing high, we should get what? A retracement, right? Away from the highs, right? Or in some cases, we could get what? Full-blown reversal, right? Where price changes in its trend. Okay, so that's the usual expectation. So that being said, when price is taking out internal range liquidity, you're basically looking for trades that's going to expand in the direction of the trend. And during periods where we're taking out external range liquidity, could be an old high here, price taking out. As price takes it out, I'm starting to see confirmation, I'm starting to see signs. We can take what? Retracement plays back into the range. And also in some cases, you could get full-blown reversal that price takes out external range liquidity. So that was basically what I was trying to put out there and explain. Internal range liquidity for expansion, external range liquidity for reversals and retracements. All right. So that's basically a brief recap to everything I put out in that thread. All right. So let's carry on. All right. Now that we've looked at the relationship between internal and external range liquidity, right? So phases of price delivery. Let's look at a bit of what I mean on the price charts. Let me just quickly delete all this paintings I did earlier. Okay, so what's the relationship between internal external liquidity to phases of price delivery, right? I've explained that. So let's look at it on the charts. So we can see here in this scenario, right, price is obviously in a downtrend since tapping into the supply zone. So we're expecting bearish movements, right? We're expecting the bearish trend to obviously continue. So what do we see here? We see price come up here to take out this, right? This is an internal range liquidity, right? Why is it internal range liquidity? It's resting between what? This high and this low. So that's the range. So this is resting within that range. So we see price take out internal range liquidity. And after internal range liquidity was taken out, soon after we get expansion to the downside. The same vein, we now have a new range, right? Which is this high to this low. So like I said, your range low, right, or range high can also act as external range LQ. So what do we see after external range gets taken out? Retracement begins. Like we explained, internal range liquidity to expansion, continuation, external range liquidity to reversal, retracement. So that's what we get here. We get a retracement back into this level where price eventually takes out what? Another internal range LQ, continues to the downside, which for the range low. After range low was taken out, what do we get? We get a pullback or a retracement back into what? An area of internal range liquidity. After that gets taken out, we get expansion outside of the range. After that, we get a pullback back into the range. Price mitigates this area of strong supply and all of that. So this is just like a simple example to show you guys how price kind of like keeps operating with internal liquidity, external range liquidity, and all of that, and how it correlates to the phases of PD, like I explained. So that being said, how then do you anticipate what should be taken out as a liquidity? That's the confusion a lot of traders come into contact with when it comes to liquidity. I'm just going to give you a very, very simple explanation to this that works 70% of the time. Now, if you're familiar with market structure, you understand that price bullish scenarios or in the bullish markets, we expect price to put in what? Higher highs and higher lows. Okay, that's the common theme. But one thing I want you to also notice, and one thing I want you to also point out or look out for when it comes to price action is the fact that levels that do not take out liquidity, a level like this, say for example, just use as a scenario. So if you do not have a structural level that takes out a source of liquidity before the creation of a new high, right, or a new low, right, if I revert this. So if you don't have a scenario where price is taking out liquidity before the break of structure, that is likely a weak level or a weak low. Now, one thing that is consistent with weak levels is more often than not they're going to get raided. So let's use this as an example where we just have a pullback like this. Now, more often than not, this weak low is going to get raided. Why? Because it's going to serve as a sort of liquidity, or what most people will call an inducement. Price is going to take out that level before a main move begins. So this is something you want to easily look out for when it comes to price action. All right, just look out for what structural level is strong, what structural level is weak. Now, this can also correlate or apply in your internal structural analysis. All right, so let's say we have something like this, right? And a failure. Now, looking at this, you can see that we have this low as the swing. We have this as the swing low. We have this as the swing high. And this is internal. Now, this is going to easily serve as internal range liquidity. Why? Because it does not take any sort of liquidity before the break of structure. So the expectation just becomes price should take this and continue to the other side. On the flip side, we could have a scenario where it actually takes liquidity. So I'm going to try and redraw that scenario. So we could have a scenario like this where there's a sweep of LQ before the break to the upside. In a scenario like this, yes, you can actually anticipate this low holding as a solid point of interest for you to take your plays to the upside. Why? Because this is now a strong low since it has taken out liquidity before the break of structure to the upside. So very, very generic, very, very simple thing. Weak levels, right? So weak levels equals to no sweep before break of structure, right? Strong levels equals sweep before break of structure. So this is a very, very simple way to filter your levels when it comes to liquidity and take way better trades. I'm going to show you an example of this here in this same price action. So you can see here in this, all right, so you can see this minor high here before the break of structure. There's no run of LQ. So that's why it serves as a very, very good internal range liquidity. Same thing here, this minor high, it's just reactionary to this demand. You can see after the failure, price just comes back to take it. All right, and it serves as a very, very good internal range liquidity. Also bear in mind this previous high, that swept liquidity, also serves as a very, very good area of interest. Right, so if I'm to mark out the food supplies on here, it's going to be the candle that takes out liquidity. Right, so you can see how price trades into that range and it sells off. Okay, so this now serves as a strong level since it took liquidity before the break of structure. While this internal high is weak, Why? Because it doesn't take out any sort of liquidity before it breaks to the downside. So we sweep liquidity here, we break to the downside. This level now is what is going to act as a strong level. That's why we easily see price trade into this area of supply, right, before selling off to the downside. So that's basically how we look at this. Very, very easy. That's a very, very easy way for you to filter your areas of liquidity and also pick out better points of interest, right, when it comes to trading price action. So in the next video, I'm going to be talking about time-based liquidity. I've just explained the generic term to like liquidity, how to pick out better levels. And the next one is talking about time in relation to liquidity. Certain types of liquidity that easily get run as well based off the facts or based on their relation to time. So I'm going to talk about that in the next video. So see you on the next one. Peace.